You know, there's something peculiar about the way people approach investing. They come to the market expecting that the most intelligent will win, that the fastest will profit, that the most informed will succeed. They believe that excitement and opportunity are somehow connected, that finding the next big thing requires action, energy, and a willingness to move quickly when opportunity presents itself. And yet, if you look at the actual results over 50, 60, 70 years, what you find is that the people who made the most money were often the ones who did the least. They were the ones who sat still. They were the ones who, quite frankly, bored themselves and everyone around them with the simplicity of their decisions. The market does not reward what people think it should reward. It does not care how smart you are. It does not care how many hours you spend reading reports or how sophisticated your analysis might be. The market rewards one thing above all else, and it's the one thing that almost nobody wants to hear because it contradicts every instinct we have about success in a modern world. The market rewards the ability to do nothing when nothing is the right thing to do. It rewards the capacity to be unexcited when everyone around you is thrilled. It rewards people who can look at volatility, chaos, and drama and feel absolutely nothing. That's not a natural state for human beings. We're wired to act. We're wired to respond. We're wired to feel like doing something is always better than doing nothing. But in investing, that wiring is precisely what destroys people. I've watched this happen for decades. Someone discovers the stock market. They read a book, maybe two books. They open an account. They feel that rush of possibility, that sense that they're now participating in something important, something that could change their financial life. And what do? They start looking for ideas. They start scanning for opportunities. They want to find something that nobody else has found, some company that's about to explode, some trend that's just beginning. The very act of searching makes them feel productive. It makes them feel like an investor. But searching is not investing. Searching is entertainment. Searching is the feeling of being involved without the discipline of being right. And here's what happens next. They find something. It doesn't really matter what it is. It could be a technology stock, a small cap company, a cryptocurrency, a rumor they heard at dinner. What matters is that it feels exciting. It feels like opportunity. It feels like they've discovered something special. So they buy it. And maybe it goes up a little bit. Maybe it goes up a lot. And now they feel validated. They feel smart. They feel like they understand how this works. So they look for the next one and the next one and the next one. And what they don't realize is that they've stopped investing and started gambling. They've confused activity with progress. They've confused excitement with edge. The truth is that excitement and investing are inversely related. The more excited you feel about a decision, the more likely it is that you're paying too much, that you're overly optimistic, that you're ignoring risks you should be considering. Excitement clouds judgment. It makes you focus on what could go right and ignore what could go wrong. It makes you pay prices that only make sense if everything goes perfectly. And in investing, nothing ever goes perfectly. There are always surprises. There are always setbacks. There are always moments when the story doesn't unfold the way you imagined. The question is whether you've paid a price that leaves room for reality to be messy, or whether you've paid a price that requires perfection. Most people pay for perfection. They get excited about a story and they convince themselves that this time is different, that this company is special, that they've found something that other people have missed. And maybe they have, but even if they're right about the company, they're often wrong about the price. And in investing, being right about the company but wrong about the price is the same as being wrong. You still lose money. You still sit there watching your account shrink, wondering what happened, wondering why being right didn't lead to profit. I learned this lesson the hard way. Early in my career, I bought companies because they were cheap. I didn't care if they were exciting. I didn't care if they were growing quickly. I just wanted to know if I was paying less than the business was worth. And sometimes I bought things that were cheap for a reason. I bought businesses that were in decline, businesses that were poorly managed, businesses that were in terrible industries. I bought cigar butts, as I used to call them. You'd find them on the ground, take one last puff and throw them away. And you know what? I made money doing that for a while. But it wasn't a good way to build wealth. It was exhausting. It required constant vigilance. It required selling things before they got worse. It was cheap, but it wasn't boring. It wasn't simple. It wasn't the kind of investing you could do and then forget about for 10 years. What changed everything for me was understanding that the best investments are the ones you don't have to think about. They're the ones where you can look at a business, understand what it does, understand why it will still be doing it in 20 years, and then just sit there. You don't have to monitor it every day. You don't have to worry about quarterly earnings. You don't have to wonder if the competitive landscape is shifting. You just own a piece of a wonderful business and you let time do the work. The problem is that these investments feel boring. They don't give you that thrill of discovery. They don't give you something to talk about at parties. They're usually companies that everyone already knows about, companies that have been around for decades, companies that do simple things in simple ways. But those boring companies have a way of compounding value quietly, relentlessly, without drama, without excitement, without requiring you to do anything except remain rational. And that's the hardest part, remaining rational. You'd think it would be easy. You'd think that once you understand the principles of investing, once you know what works, you just do it. But knowing what to do and being able to do it are entirely different things. I've known plenty of intelligent people who understood intellectually that they should buy good businesses at fair prices and hold them for long periods of time. They could explain the logic. They could cite the evidence. But when the market dropped 20%, or when some new trend emerged, or when their neighbor told them about a stock that tripled, they couldn't help themselves. They had to do something. They had to act. And that need to act, that inability to sit still, cost them dearly. The market is designed to separate you from your money by making you feel something. It makes you feel fear when prices drop. It makes you feel greed when prices rise. It makes you feel envy when others are making money in areas you're not. It makes you feel impatient when your holdings aren't moving. It makes you feel smart when you make a quick profit. It makes you feel dumb when you miss a rally. All of these feelings are designed to make you trade. And every time you trade, you create friction. You pay commissions. You pay taxes. You make mistakes. You buy high because you're excited and sell low because you're scared. You convince yourself that you're being active and engaged, but what you're really doing is destroying your own returns. The people who make money in the market are the ones who can look at all of that drama and feel nothing. They're the ones who can watch their portfolio drop 30% and not sell. They're the ones who can watch a speculative stock go up 500% and not feel like they're missing out. They're the ones who can hold the same investments for 10, 20, 30 years without getting bored, without wondering if there's something better, without needing to prove that they're smart by finding the next big thing. That level of emotional control is rare. It's uncomfortable. It goes against every instinct we have as human beings. But it's the only thing that works. And it works because of compounding. Compounding is the most powerful force in investing, but it requires time. It requires you to leave your money alone. It requires you to let profits reinvest, let dividends accumulate, let businesses grow without interference. Most people understand compounding in theory, but they don't have the patience to let it work in practice. They interrupt it. They take profits too early. They move money around. They convince themselves that they can do better by being active. And every time they do that, they reset the clock. They start compounding over again from a smaller base. They create taxes and transaction costs that didn't need to exist. They turn what could have been a simple, boring, extraordinarily profitable experience into a complicated, exhausting, mediocre one. Ivy always said that the stock market is a device for transferring money from the impatient to the patient. And that's exactly what it is. The impatient person sees a stock go up and wants to buy it before it goes higher. The patient person waits for a fair price. The impatient person sees a stock go down and wants to sell it before it goes lower. The patient person sees an opportunity. The impatient person needs to know what's going to happen next quarter. The patient person doesn't care because they're thinking about the next decade. The impatient person wants to feel like they're doing something. The patient person is comfortable doing nothing. Now, doing nothing doesn't mean being passive in your analysis. It doesn't mean buying something without understanding it. It doesn't mean ignoring risk. What it means is that once you've made a good decision, You don't second guess it. You don't let the market's daily movements change your mind. You don't let other people's opinions shake your confidence. You don't let boredom drive you to make changes that aren't necessary. You recognize that in investing, inactivity is often the highest form of activity. Sitting still is often the hardest work you'll ever do. And part of sitting still is understanding risk, not the kind of risk that academics talk about, not volatility or beta or standard deviation. Real risk, the risk of permanent loss of capital, the risk that you paid too much for something and you're never going to get your money back, the risk that the business you own deteriorates and doesn't recover, the risk that you're wrong about something fundamental and it's going to cost you. That's the risk that matters. And the way you manage that risk is not through diversification into 50 or 100 different stocks. The way you manage it is through discipline. You only buy things you understand. You only pay prices that make sense even if things go wrong. You build in a margin of safety so that you can be wrong about some things and still come out ahead. Most people don't think about margin of safety. They think about upside. They think about how much money they could make if everything goes right. They calculate best case scenarios and convince themselves that those scenarios are likely. But best case scenarios are called that for a reason. They're the best case. They're not the likely case. The likely case is somewhere between the best and the worst. And you need to pay a price that works even in the likely case. You need to leave room for disappointment. You need to assume that you're going to be wrong about something because you are. Everyone is. The difference between people who survive their mistakes and people who don't is whether they paid a price that had room for error. I've made plenty of mistakes. I bought businesses that didn't work out. I've misjudged management teams. I've been too optimistic about turnarounds. I've held on to things longer than I should have. But I've survived those mistakes because I didn't bet everything on being right. I didn't use leverage. I didn't pay prices that required perfection. I built in room for reality to be messy, for my judgment to be flawed, for circumstances to change, and that margin of safety, that buffer between what I paid and what something was worth, is what allowed me to compound wealth over decades instead of blowing up in a year. The people who blow up are always the ones who are certain. They're certain they're right. They're certain they found something special. They're certain that this time is different, and that certainty leads them to take risks that don't make sense. They use leverage because they're oh, sure, it's going to work. They concentrate everything into one idea because they don't want to dilute their returns. They ignore warning signs because they've convinced themselves of a narrative. And then something goes wrong. It always does. And they lose everything because they didn't leave room to be wrong. The irony is that the people who are humble about their judgment, who assume they're going to be wrong sometimes, who build in safety margins and diversify reasonably and don't use leverage, those are the people who end up being right more often, not because they're smarter, but because they survive long enough to benefit from the times they are right. They don't blow themselves up. They don't take themselves out of the game. They stay in the game long enough for compounding to work, for good decisions to accumulate, for time to smooth out the mistakes. And time is the key to everything. Time is what turns a good business into a great investment. Time is what allows compounding to reach exponential levels. Time is what separates the people who get rich from the people who stay rich. But time requires patience. It requires the ability to delay gratification. It requires ignoring the constant stream of news and opinions and predictions that tell you to do something different. It requires trusting that boring, simple, repetitive decisions will produce extraordinary results if you just let them work. Most people can't do that. They need stimulation. They need to feel like they're involved. They need to check their portfolio every day, read every headline, react to every piece of news. They turn investing into a full-time emotional experience when it should be a part-time rational activity. And that constant engagement, that constant need to be involved is what costs them. Because the more you engage with the market's short-term movements, the more likely you are to make decisions based on emotion rather than analysis. The more you check your portfolio, the more volatility you experience. The more volatility you experience, the more likely you are to panic or get greedy. And panic and greed are the two emotions that destroy wealth faster than anything else. I've never understood why people make investing so complicated. They use complex strategies, sophisticated instruments, elaborate theories about market timing or factor investing or algorithmic trading. They convince themselves that complexity equals sophistication, that if they just find the right formula or the right system, they'll beat everyone else. But investing isn't about finding a secret formula. It's about doing simple things consistently and not getting in your own way. It's about buying good businesses at reasonable prices and letting them compound. It's about ignoring noise and staying focused on fundamentals. It's about being boring when everyone else is trying to be clever. And boring works. Boring has always worked. Boring will always work. Because boring means you're focused on what matters instead of what's exciting. Boring means you're thinking about decades instead of days. Boring means you're building wealth instead of chasing performance. Boring means you're comfortable being out of step with the crowd, comfortable missing trends, comfortable looking unsophisticated, and that comfort with being boring, that willingness to be uncool and unstimulated and patient, is what separates the people who build lasting wealth from the people who are always searching for the next thing. The next thing never works, or rather, it works for someone, but it's almost never the person chasing it. By the time you've heard about the next big thing, by the time it's exciting enough to catch your attention, it's usually too late. The easy money has been made. The price been bid up. The risk has increased. What you're buying is an opportunity. What you're buying is other people's excitement, and excitement is expensive. Excitement requires everything to go right just to break even. Excitement doesn't have a margin of safety. Excitement is the opposite of investing. Real investing is boring. It's buying Coca-Cola and holding it for 30 years. It's buying See's candies and letting it compound. It's owning pieces of businesses that do simple things that people need and will continue to need. It's collecting dividends and reinvesting them. It's ignoring market crashes because you know they don't matter if you're not selling. It's ignoring market booms because you know they don't matter if you're not buying. It's treating your portfolio like a business you own, not a collection of ticker symbols you trade. And when you treat investing like business ownership instead of trading, everything changes. You stop caring about daily price movements because you know that daily price movements don't affect the value of the underlying business. You stop worrying about what the market thinks because you know that the market is often wrong. You stop needing to be right immediately because you know that being right eventually is what matters. You develop a sense of calm, a sense of perspective, a sense of confidence that comes from understanding what you own and why you own it. That calm is what the market can't shake. The market can make prices go up and down. It can create fear and greed. It can generate noise and confusion. But it can't make you sell if you don't want to. It can't make you buy if you don't see value. It can't force you to act if you're comfortable doing nothing. And when you reach that point, when you've developed the emotional discipline to remain rational regardless of what's happening around you, that's when you've BICO, a real investor. That's when you've stopped being a participant in the market's emotional drama and become a beneficiary of other people's mistakes. Because that's what investing really is. It's profiting from the gap between price and value that exists because most people are emotional. It's buying when others are fearful and the price is below value. It's selling when others are greedy and the price is above value. It's recognizing that the market is not efficient in the short term, that it's driven by human emotion, and that human emotion creates opportunities for people who can remain rational. But you can only take advantage of those opportunities if you're not swept up in the same emotions as everyone else. You can only profit from fear if you're not fearful. You can only profit from greed if you're not greedy. And the way you avoid being swept up in emotion is by having rules, not complicated rules, simple rules. Rules like only buy what you understand, only pay prices that make sense, only invest in businesses with durable competitive advantages, only invest with management teams you trust. Build in a margin of safety. Don't use leverage. Don't trade frequently. Don't let taxes and transaction costs erode your returns. Think long term. Be patient. Be boring. These aren't sophisticated rules. They're not clever. They're not going to impress anyone, but they work. They've worked for 100 years. They'll work for another 100 years because they're based on principles that don't change, principles about value and risk and human nature. Human nature doesn't change. People will always be fearful when prices drop. People will always be greedy when prices rise. People will always want to feel smart and involved and active. People will always prefer excitement to boredom. And as long as human nature doesn't change, there will always be opportunities for people who can resist those instincts. There will always be a reward for being boring when others are exciting. There will always be a reward for being patient when others are impatient. There will always be a reward for being rational when others are emotional. That's the great secret of investing. It's not complicated. It's not about finding secrets or having access to information others don't have. It's about having the emotional discipline to do what you know you should do, even when it's uncomfortable. It's about sitting still when every instinct tells you to move. It's about ignoring the noise and focusing on what matters. It's about being boring, deliberately boring, proudly boring, because boring is what wins. Wealth is not built by people who feel excited. It's not built by people who find investing thrilling or stimulating or entertaining. Wealth is built by people who find investing mildly tedious, by people who check their portfolio once a quarter, by people who can describe their investment strategy in 2 sentences, by people who have held the same stocks for 20 years and plan to hold them for 20 more. These people don't have interesting stories. They don't have dramatic wins or crushing losses. They don't have anything to brag about at dinner parties. But they have wealth. They have compounding working in their favor. They have time as their ally instead of their enemy. And that's the choice you have to make. You can make investing exciting and entertaining and stimulating, or you can make it profitable. You can chase the next big thing, or you can own wonderful businesses. You can trade frequently, or you can sit still. You can try to be clever, or you can try to be right. The market will reward whichever choice you make, but it won't reward them equally. It never has. It never will. The market rewards boring decisions and punishes excitement. It always has. It always will. The only question is whether you can accept that truth and act accordingly, or whether you'll spend your life searching for a different answer that doesn't exist. Because here's what I've learned after more than 7 decades of doing this. The answer is boring. The answer has always been boring. And the people who can accept that, who can embrace that, who can build their entire investment philosophy around that one simple truth, those are the people who win. Not because they're smarter, not because they work harder, but because they can remain rational when others feel something. And in the end, that's the only edge that matters.